here with Robert Mitchell of Mitchell Insurance Services. And today we want to talk a little bit about insurance rates. So in January, the new insurance rates come out. Robert, do we know what they're going to be yet? Do we have any idea of increases? You were going to tell us a little bit about that.
Yeah, well, what you're talking about in January is the reinsurance rates, which reinsurance obviously is the insurance that the insurance companies that we work with purchase to protect their portfolio. There's two big renewal dates for reinsurance. It's June and July, and then January 1st. And so what we're seeing or what we're hearing is that, the reinsurance rates are going to continue an upward trend. So there was about a 15 to 20% increase during the summer renewals, and then they're projecting similar increases for the January 1st renewals. So what that means for associations when they're purchasing insurance, they will ultimately feel a price crunch or a price increase, because when the reinsurance rates go up, the insurance companies offset that cost to the customer by revising their price models, and so it ultimately means more premium to be paid by the associations.
They can expect this as of January 1st, or you're saying some of them have already been experiencing it throughout the end of this past year?
Throughout the whole year, we've been seeing price increases, and it's really been a trend that started last year. The first quarter of this year, it was the higher risk associations. And what I mean by that, older buildings, older roofs, closer to the coast, those associations were seeing anywhere from 5 to 20% increases in the quarter one. But then the associations that were newer, a little bit more inland, they were seeing either flat renewals or minor increases. Once COVID happened, it kind of created a bomb of uncertainty in the insurance marketplace, which amplified the other factors that were already driving pricing increases. So after quarter one, we saw average increases going from 5 to 10% to 15 to 20%. And obviously COVID plays a role in it, but this is something that has been kind of brewing in Florida since 2017, when obviously we had Irma here locally, but 2017 was the costliest storm season in recorded history. The estimated losses, which are still actually climbing, are around $215 billion, which was actually $45 billion more than the storm season which Katrina hit Louisiana. So pricing has been wanting to move upward, at least on the carrier side, for a few years now. Now it's finally starting to happen.
I was just going to say, for a while there, they were seeing a nice steady trend of where it was just kind of, they were renewing, not a whole lot of change in pricing. And then now, finally, from Irma, we're starting to see that effect.
Yeah, what's going on is we're entering what's called a hard market. And the last time that we had a hard market for insurance was back in 2005, 2006. And obviously that was after the storm seasons, which we had Charlie and Wilma and a host of storms that created havoc on the Florida coastline. But then we had 10 years where we didn't have a major storm make landfall. And so during those 10 years, insurance companies started forming in the state. More competition was created, so it was driving pricing down. So for a long time, a lot of associations were renewing their policies year over year with decreases that ranged anywhere from 5% to 20% to, in some extreme cases, 50 or 60%. One of my associations that I've worked with for going on 10 years now, back when I first took them over, they were paying about $450,000 a year for their property and liability premiums. And even with the increases that they took this year, they're still only paying $230,000. So while pricing is going up, in some cases, it's not back to the levels it was when we were in our last hard market. And the reason why we're seeing pricing go up is the realized losses from all of the storm activity for 17, 18, 19, and now 20. But also there's just a very poor litigious environment in Florida right now, where insurance companies are being sued left and right, not always merited based lawsuits either. And it's causing these claims expenses to increase, which is obviously reducing their profit. And that all falls back on the policyholder, which is us and the associations.
Have you seen many property markets pull out here recently?
Some markets have been impacted more than others. We haven't seen a wholesale exodus of insurance companies in the state, but what we've seen is a much more stringent underwriting guidelines for these companies. And so if we have if we have before the end of the storm season, a major, Cat 3, Cat 4, Cat 5 storm hit, we may see insurance companies, go insolvent. It's not so much a problem on the commercial side. And the commercial side, I mean, the policies for the master association, but on the personal line side, there's a few homeowners insurance companies that are kind of hanging on by a string financially and basically keeping their fingers crossed that a major storm doesn't hit this year so they can, so they can stay alive. But what we're seeing is capacity is being reduced in the state of Florida. And what I mean by that is the money that's available to basically write insurance for certain parts of the state isn't there anymore, or it's the reinsurance is more expensive. And so we haven't seen, like I said, we haven't seen a wholesale exodus of insurance companies in the marketplace, but what we have seen is we have seen these companies tighten up their underwriting, and they're not taking as much risk as they were in the years past. And so that means, pulling out of certain counties, not wanting to write on the coast, or implementing higher deductibles on policies that do have a little bit more catastrophic exposure or hurricane exposure.
That's scary. How are we doing on the liability side? We still have the same markets and everything. You still have those programs that will offer those extra coverages for under the D&O and the liability for board members and whatnot?
Yeah, so on the liability side, we still have the directors and officers. There's still a number of markets that are available that offer these comprehensive coverages and endorsements specific to community associations. But what we're seeing on the general liability side, it's kind of a crisis is a big is kind of a scary word, but in a way we're seeing a liability crisis, because what's happening, not only are associations getting sued for frivolous lawsuits more and more, but what we're also seeing is personal insurance companies. So the unit owner's policy, they're subrogating against association policies for any damage that occurred to the unit that they insured and they paid out. So what I mean by that, when you subrogate, it's demanding payment for the loss from a party that was deemed to be responsible. So what's going on, as an example, we have a bunch of older buildings in Florida, so 70s, 80s, 90s. As these buildings age, even well-maintained buildings can have pipe leaks, pipe burst, things of random nature that you can't plan for. So let's say there's a sewer backup from a common line into one of the owner's units. That owner files a claim with their insurance company. The insurance company pays out, let's say $15,000 to replace the flooring, the cabinets, and the components of the unit that they're responsible for covering from an insurance perspective. Well, 3 to 6 months down the road, the association will receive a subrogation demand from either the insurance company or a law firm representing the insurance company, alleging that the damage occurred because the association was negligent. Now, in most cases, there's no negligence on the association's behalf, but this is a tool that the personal insurance companies have found that they can use to reduce their claims expense. And what that's causing on the association side is a skyrocketing number of claims that the liability companies are having to defend, which is increasing those claims expenses. And over the last few years, we've seen on average year over year rate increases of anywhere from 10 to 30% on the general liability. But it's gone unnoticed because the property insurance rates have been going down or staying the same. So, and the liability rates compared to the property premiums, they're, property is obviously much more expensive. So that's where people tend to focus their time and efforts. But now that the property rates are going up, people are more aware of the fact that the general liability rates are going up. And so associations are kind of getting hit on two fronts. The scary thing about this is, because of this subrogation issue and just the general litigious environment of Florida, a lot of the companies that historically were offering general liability insurance for community associations have pulled out of the market altogether, or they've implemented rate increases of anywhere from 60 to 100%, or they're putting in exclusions that basically render the policy useless. Uh, and it's not much more than just a piece of paper that says there's general liability policy in place, but the coverage spectrum is so narrow that there's major issues whenever a claim may occur. So right now there's about 3 markets that are actively writing GL or general liability insurance in the state that have a very comprehensive coverage form. And and when I say you, I mean the association, if you have a poor claims history, whether it's a number of these subrogation issues, or you have slip and falls, or whatever the case may be, if you have a poor claims experience or poor claims history, and those three companies don't want to write you, then you have to go to one of the non-standard markets, and their pricing is significantly higher than what you see with those 3 companies. And so, I saw one this year where they were paying $9,000 or $9,500, and because of because of underwriting changes and their loss experience, the company that was handling them pulled off, and the replacement policy was around $35,000.
Wow. One thing people need to recognize is that when they get thrown into that non-standard market, in addition to the pure premium that they'll be paying, they're also now going to be paying any kind of inspection fees and also taxes on top of that they weren't seeing before with the standard markets that they were in. I guess the thing right now is for them to be wary of the changes going on in the market, especially if you have an open claim, you need to stay put. Do you recommend any kind of discussion you want to have with that, with the market, the way it's changing right now? What we need to be cautious of is losing these policy inclusions that offer the extra coverage for community associations. And it goes back to a discussion I actually had with one of your associates just yesterday. Kip Kohlmeyer and I were discussing working with agents that aren't on top of community association coverage forms and the different endorsements that are provided for community association directors. Anything you want to touch on in regards to moving around right now with it being a weird year like this? Changing companies, changing agents?
Yeah, so right now, because of pricing going up the way it is, it's easy to want to go out and basically, try to get bids to see if there's anything cheaper. The one thing I'll say about that is, condo insurance is a little bit different than if you're trying to buy auto insurance or homeowners insurance. You can't typically just go out to 3 different agents and have them bring you back 3 different prices from 3 different companies and have 3 different proposals put together with apples to apples coverage, and so you can review and basically come to a price determination and decide which agent you want to work with that way. Because of how the insurance is allocated, the agents that you work with typically have access to the same markets, and those markets typically work on a first come first served basis, meaning that the agent that gets the applications to them first is going to be the one that they're going to allow to quote with them. And so if you go to 3 different agents and they all go to the same market, the person that got there first is going to be the one that is going to be able to get the bid for you, and that might be the best market. Right now, what I try to tell associations is, don't look at shopping an agent based on price. If you're unhappy with your agent based on service, that's one thing, but now more than ever, you need to work with someone who you trust. I make the comparison all the time. If you get a DUI, you're not going to hire a tax attorney. You're going to hire a DUI attorney. It's the same thing with condo insurance. You got to look at it as you're hiring a professional. You're hiring someone that you can trust, who can go out to the market for you, be your advocate in the market, do all the shopping for you, and go to the markets that are available, negotiate with them, and create an internal competition between those markets. And then we come back and we bring you the best options and the best prices. So with all that said, now is a time where if you have a good agent, they're extensively shopping your property insurance, your liability insurance on your behalf, and they're coming back to you with the options that are available to you in the marketplace. As it pertains to open claims, every claim's a different scenario, and so sometimes you can move if you have an open claim, but if there's a major issue, it's not always the best idea. And so what I can say now is, more than ever, you want to have a relationship with an agent who you trust, who's knowledgeable in condo association insurance, and will be responsive to the needs of the association.
Well, thank you, Robert. We really appreciate you giving us input on this, and that's why we're doing these small education segments, just to give all of the board members and the managers tips on what to expect. Anything you want to say in closing?
Just that, it's a wild ride right now, and for those that have been on condo boards or in property management for a while, know that the pricing was going down for a bit, but it's going up now. Insurance is cyclical, so it goes up, it goes down. And right now is the time that we're riding out the storm. There's certain things that we can do to try to curb the price increases, and it's mostly through legislation. So that would be one thing that I would advocate. Talk to your legislators, talk to BMI, follow up with us as BMI or other trade associations who have lobbyists up in Tallahassee. Because if we can curb some of the lawsuits, first the subrogation issues and some of the first party litigation against the property insurance, then we can curb some of these price increases over time. But if this continues to run rampant, we could be in for a long extended period of pain in terms of pricing increases, because we can't predict hurricanes. We don't know when the storms are going to hit, but what we can predict is the legislation to reduce all of the lawsuits that are being filed against the insurance companies. There was one guy in South Florida who filed 17,000 lawsuits against property insurance companies in the state by himself. None of them had any merit behind them, and ultimately he's been suspended by the Florida bar. But that's the type of rampant fraud that's going on, that's ultimately leading to higher costs for the associations and the clients.
That's scary. Well, thanks, Robert.
Yeah,
I really appreciate your help.
absolutely. Thanks for having me, and anyone who's listening, please feel free to give me a ring if you have any questions.